following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and that rockin' theme means it's time once again for Options Bootcamp, the show where we break down raw options recruits and then slowly rebuild you into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network, upon which many of you are listening to this fine program right now. And joining me on the Options Bootcamp Drill Instructor Squad, starting off with the man of many sound effects, none other than Dan Passarelli, the major domo over there at Market Taker Mentoring. Dan, welcome to the show.
Hey, I left my slide whistle in my other office.
I set you up for fantastic sound effects, and you let all of our listeners down.
Here, how about this one?
There you go. There you go.
All I got.
I didn't know you had a second career in the Police Academy movies.
Yeah.
You have a man of many skills and talents over there at Market Taker Mentoring. Dan, how are you doing today?
Not too bad, Mark. How about yourself?
I am doing good. You ready for some boot camping?
Darn straight.
All right. And also joining us on our drill instructor squad, he is indeed the meanest of the bunch, the one all the recruits are scared of, none other than John Critchley from Sogo Trade. John, welcome back to the show, to you as well.
Yeah, hi, Mark. Hi, Dan. I've been just recently released from the boot camp infirmary, so if my voice is a little hoarse, I apologize to our listeners in advance.
You were screaming at those recruits too much. I warned you. I said, you got to ease it up a little bit, John, otherwise you won't have anything left for the show. And sure enough.
I also want to know, when do I become the major domo? I know Dan's that. I want to be the major domo.
You want to be the major domo of Sogo Trade? All right, I'll check with the Sogo Trade folks and see if they can put that on your business card for you. All right. I don't want to upset the apple cart over there in Sogo Trade land. All right. And with the team assembled and our whistles at the ready, we're going to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, and welcome to our basic training segment. This is, of course, where we walk you through some basic options concepts in an attempt to better prepare you as an equity trader for entering the world of options. And today's topic is going to be a little bit of a revisit and a little bit of an extension of a topic we hit upon much earlier in some very, very early episodes of the show. We touched upon the subject of spreads, listeners, and those of you who have been with us for a while may remember that. But it has been a while, A, and B, this is such an important topic that really it merits revisiting and revisiting at some length. So what we're going to do is devote this episode and the next episode of Options Bootcamp to this pivotal topic, because really at the end of the day, a lot of people will come to me at Options Insider and say, I'm an equity guy, or I'm a stock guy, I'm a bond guy, what have you. What is it about options that makes them unique? Why should I be interested in trading them? And invariably, there are a lot of reasons we talk about flexibility, things like that. But invariably, at the end of the day, it really comes down to spreads and that spread capability, that spread functionality that allows you to really do whatever the heck you want to do using options. If you want to be synthetically bullish, you can do that. If you want to just have a risk-limited, long, bullish, speculative position, you could do that. If you want to protect a stock position, you can do a number of different things, almost limited only by your imagination, using options. But the way you do that is through spreads. And so really, if we're going to accomplish our goal here on the Options Bootcamp program of taking you from the raw options recruit to the seasoned options veteran, we really need to spend some significant time strengthening your spread skills. So that's what we're going to endeavor to do on today's program and on the next program of Options Bootcamp. Before we dive into the hardcore nitty-gritty, if you will, of spreads, let's maybe start off with a quick review of what spreads are and why you might be interested in pursuing these strategies. Now, Dan, I know over there at Market Taker Mentoring Land, you spend a lot of time. In fact, I would go out on a limb to wager that the bulk of your time is spent educating your clients about spreads and when to use them, how to use them effectively. So why don't you walk some of our listeners here through some of the reasoning, A, what spreads are, obviously the basic starting point, and then B, some of the reasons why you want to think about using these strategies, some of the benefits they convey to you.
Sure, Mark. I just had a conversation this morning, a couple hours ago, with a student about spreads.
See, I was right. I knew it.
I know. You're always right, Mark. That's why you're the major domo.
That's why I'm in the big chair. I get the big bucks. I have the big whistle.
I know. All right. So here's what spreads are. I mean, spreads are very simply two option positions, if you will, that are entered at the same time as one single trade. For example, a trader might buy, say, a January 50 call in some particular stock, and at the same time sell a January 55 call, thus having both of those individual option positions on at the same time. The trader thinks about this trade as one single trade unit, as a spread. And the reason why somebody might do this is because when you start getting into spreading, you're able to fine-tune your risk and trade a lot smarter. Whenever you make a trade, of course, as we've talked about on the show many times before, you always have basically three major risks: the direction of the underlying moving, time passing, and volatility changing. And when you get into spreads, you can overweight and underweight any one of those three different risks to create a position that is more favorable for you. So it's a veritable chess game. It's a way to get smarter about your trading. It's a way to reduce your risk while increasing potentially your reward.
Yes, I don't think you can really overemphasize the value and the utility and the usefulness of spreads to becoming a successful options trader. I mean, the skill you develop as a market maker on the floor, the core risk management skill that you are taught and you train on endlessly, and if you can't master, you quickly blow out, is the ability to spread off your risk. Spreads are the primary risk management tool that you utilize as an options trader. So there are so many reasons why spreads are really important in terms of their utility, in terms of their value to an options trader. And if you're the proverbial newcomer to options, you really Obviously, most of you start buying a call, buying a put, taking these very simple steps, but then you graduate to why spreads are really important, and you start graduating some of these perhaps simple verticals. And John, I know you must spend a lot of time over there at Sogo as well, walking through this exact same scenario, answering this exact same question. So what do you tell the Sogo clients when they call you up and say, hey, John, why should I care about spreads?
We get the question all the time, as I'm sure you guys do, why should we use spreads? And what I always try to say is, where options really distinguish themselves from equities or other investment products is in spreads. I mean, if you have spreads, they can be used as a risk reducer. You can spread the risk, as the spread name implies. It's an excellent stock repair tool. And I think that we can maybe touch on that later, but that's really an important way that you can use spreads. Also, spreads allow you to risk manage your positions. You going into trade, you know where your maximum gain is and your maximum losses, and so it's really good for the customers to use spreads to fortify their positions or to reduce the risk, to do stock repair. Buying calls and puts and doing coverage calls, that's the meat and potatoes. But the spreads are the filet mignon. And if you learn how to use spreads correctly, you're well on your way to becoming a successful options trader long term. All market makers, and Dan and Mark can go to this, or traders, they're really volatility traders. We say that, but boy, they're spreading every trade spread off. You buy something, you sell something else. You sell something. It is just constantly spreading off. So if the pros are doing that, and they've been doing it for years, then if you're a retail customer and you can master that to some degree, you're going to be much better off in the long run.
I like that. Spreads are the filet mignon of the options world. Of course, even if you're a vegetarian, the spreads can still be useful for you. They're still definitely a desirable thing. And talking about spreads, one of the common questions we receive here at Insider is once you start introducing these concepts to the newcomer to options, they've learned about the Greeks, they've learned about delta, gamma, theta, and vega, they've learned about how to apply those to a basic single leg options position. So they come in, they buy a call, they know that it has a delta of, let's say, 0.3 or 0.7 or whatever, however you want to term it, 70, 30, but they also have a vega, they know the gamma, they understand how those work, they know the time decay. But then they start perhaps looking at a vertical call spread or something like that. And that's where they start to get a little bit confused. They say, wait a minute, you have two Greeks now. You have a Greek on one leg, a Greek on the other leg. How does this work? How do I calculate that? How do I calculate the net Greek for this position? What does that really mean when I have two Greeks? How do they perform? And these are some of the tricky questions people get into when they first start getting into spreads. Fortunately, listeners, we have the man here who literally wrote the book on the Greeks. And so, Dan, why don't you walk our listeners through some of the basic spread concepts and how they apply to the Greeks?
Sure, Mark. Whenever you make an option spread trade, as I defined it before, it's basically two separate options that are combined to make one trade. So what a trader needs to do is to take the Greeks of the one component of the spread, or what we call the one leg of the spread, and offset those with the Greeks from the other leg of the spread. Now, typically with spreads, you're long one option and short another, and that's not necessarily always true, but much of the time it is. So when a trader's long one option, if it's a call, he'll get a positive delta and negative theta and positive vega. But then if he's also short a call, he'll get just the opposite Greeks. Negative delta, positive theta, negative vega. Now, because they're two different options in the chain, the Greeks won't be numerically exactly the same. So what the trader would do is he would combine the Greeks for each leg of the trade to get the Greeks for the spread itself. So, for example, let's just look at one of the Greeks. We'll isolate just delta. Imagine a trader goes and buys again, a January 50 call. And that happens to be right at the money. So it's got a 50 delta. It's a positive 50 delta because the trader's buying the call. Now, if he at the same time sells a January 55 call, well, that one would be somewhat more out of the money. It would have a smaller than 50 delta. Let's just say it has a 30 delta. And because the trader would be selling that one, he'd be getting short 30 deltas from that. So long 50 deltas for the call he's buying, short 30 deltas for the calls he's selling. That combines to make a positive 20 delta for the spread. The trader can do the same thing with Vega and Gamma and Theta and even Rho. All it is just taking the two and combining them. Basically one's positive, one's negative, subtract the negative from the positive, and there you go.
All right, thank you for that, Dan. And now, of course, when you start walking people through spreads and you start explaining to them how these Greeks net out, and you start reducing this and reducing that, I think the next logical question that a lot of them have is, why would I want to do that? Why would I want to net reduce my delta or reduce some of my exposure in some of these other elements? So, Dan, what say you to that oft-asked question?
It's because it gives you a more pure trade. So, for example, the numbers I gave for delta are probably somewhat realistic. When a trader trades a spread, the delta of the spread might be 40 or 50% of what the delta of just simply going out there and buying a call is. So the trader is reducing his directional risk by maybe half or sometimes a little bit more than half. What if the trader wants a directional trade? Why would he do that? It's because the theta and vega that is offset can offset 90% of each other. So for example, maybe the theta is, 3 cents a day. Well, it's probably going to be pretty close to 3 cents a day for both the long option and the short option, and the same with vega. So what I'm trying to say is traders have to, if a trader's looking for a directional trade, that trader will concede and reduce his directional risk by maybe 50%, but in doing so reduces his theta and vega risk almost entirely. So really, it's a more pure directional trade doing it that way, because you get rid of that unwanted optionality, the theta and the vega and the gamma, and you keep just the directional risk. And truth be told, hey, if you want that full directional risk, then you just trade two spreads instead of, one call, and you've got 100% of your directional risk and still just a teeny fraction of your theta and vega.
Yes, there's so many reasons why you want to employ spreads. That what Dan just mentioned being one example of that. You get the full directional exposure. There's a lot of other reasons. Of course, it limits your net premium outlay buying one contract and selling another, so it allows you to perhaps scale up a little bit on a trade that you maybe otherwise, if you were buying it outright, couldn't fully utilize your full account value on, or the full percentage of your account that you really wanted to trade, because you have to tie up so much in margin and outlay. It also allows you to do a lot of interesting things like ratios and things like that we'll get to on a future trade, but a lot of things on a future show. But a lot of things that really allow you to maximize the account. Of course, you can combine them with underlying. A lot of the people listening to the show are coming to this from a stock perspective. They have long stock positions. You can use spreads very effectively to defend and protect those hedging, perhaps picking up a long put spread to hedge that, or perhaps a collar, which you talked about in the past, buying a put, writing a covered call against it. There are so many reasons to get into them. I really want to hit on just some of the basics, and we'll get into some of the examples in a minute. In our options drills, have some specifics for you. Before we do that, too, there also are, as good as spreads are, as useful as they are, as much utility as they offer to the options trader, there are some downsides to using spreads as well. And ever the curmudgeon, John, wants to bring those up for us now. John, what are some of the downsides of spreads you'd like to warn our listeners about?
Well, so far everything we said about spreads has been how wonderful they are, and they are. I love spreads, but I think it's really important to tell the retail customer that there is one pretty big downside to spreads, and for the limited for the risk, reducing the risk, you also limit the reward. I have a quick story. Last year we had a very bright intern named Chris working with the options team, and he was this very precocious stock picker. He would come to me with different ideas, and one day he said, "I like this stock, ELN," ELAN, and the stock was about 830, the price. So I said, okay. I bought the 10-11 call spread for 30 cents. The calls were 40. I sold the 11s for a dime. It cost me 30 cents. Well, lo and behold, like within the next month, the stock went to 12.34. Now, I did make on this trade about 60 cents, but if I just straight bought the 10 calls, for 40 cents, they would have gone to 240. So, sometimes it can be a psychological hit. And I know I was saying, boy, if I just bought the calls, not tried to do the spread. So just remember that, we're extolling the virtues of these trades, but you are, by taking some risk off the table, you are limiting your rewards. Just be aware of that.
Those psychological hits sometimes can be the worst, even worse than the big money losers, because they nag at you for many months and years to come.
Well, I think that's really valid, John, because the fact of the matter is that you're going to have winning trades and you're going to have losing trades. And, when you leave money on the table on your winners, you need those winners to offset the losers and more than offset the losers to prosper. And so, leaving money on the table, it's important to not do that.
I think even though that downside is a very clear and sometimes can be a very stark one, I think all three of us here on the panel can agree that when you look at just a random sampling of options accounts, and you can look at the accounts that employ spreads versus those that just naked outright buy or sell options, I think all of us have an intuitive sense of which accounts are going to be around longer and are going to be more profitable in the long run. And 99.9% of the time, that is going to be the accounts that utilize spreads. And so that's why we want to spend some time on those listeners. That's why we wanted to do a quick recap of spreads here, why they're interesting, why they should be used for you in the basic training segment. And now we're going to dive into options drills and get into a little bit more specifics on this topic.
Calling Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, and that somewhat patriotic music means it's time for our options drills segment. This is, of course, the segment where we take some of the things we learned in basic training and take them to the next level and employ some specific examples to walk you through how these strategies can be utilized. And today, since we're talking about spreads, and particularly basic spreads, the one that most of you as retail traders tend to encounter first is the basic vertical spread. What I mean by a vertical spread, well, of course, we hit on these in the earlier episode. Quick recap, of course, you come in, you buy a call, let's say XYZ is trading at 100, then you look at selling perhaps the XYZ 105 call. And that is, we call it a vertical spread because those two strikes, those two options are in the same month, the same option chain. One is above the other. So you are quite literally trading vertically in that option chain, which is hence the term vertical. As you can imagine, horizontal will be trading across expiration months. That's a much more complicated endeavor. We'll get to that in the next show. A little tease for you, the listener. But first, we're going to hit on these basic verticals because that is really where a lot of people get their feet wet when it comes to spreads. Dan, I know you over there at Market Taker must spend a lot of time, I'd imagine, walking your clients through these basic verticals so they can get a feel for how these work. They are indeed a very important first step in getting into the spreading mindset, understanding how spreads work. So why don't you walk our listeners through an example of a nice vertical, let's say call spread, that can walk them through some of the basics of spreading.
Sure. As far as vertical call spreads go, they kind of come in two varieties, or really rather, they come in one variety, but you can buy that variety or sell that variety, sure. You can do debit call spreads or credit call spreads. So I had on a credit call spread last month in Ralph Lauren, symbol RL. Now, I traded this spread when the stock was down, probably around $151 a share. This was right around a month ago. And what I did is I looked at the stock chart and I saw that there was a good amount of resistance up at $165 a share. So presuming that many of you are familiar somewhat with the concept of technical analysis and support and resistance, but to kind of explain it in lay terms, resistance up at $165 means the stock got up to 165 and then shown that it has a hard time going through that point. It rose to there and then it came back down. And then it rose to there again and it came back down. And then it rose to there again and it came back down. So obviously that's where the sell orders are. So I was able to capitalize on betting that the stock will continue to stay below $165 a share by selling the December 165 calls and then in turn buying the December 170 calls. I created a credit call spread in the month of December. Now, what happened is a couple weeks or maybe 10 days or so after I put on that trade, lo and behold, the stock runs up and starts getting pretty close to $165 a share again. So I'm thinking, boy, I was just kind of hoping it would stay down here, because if it does, if the stock stays below that point, when expiration rolls around and the options expire, whatever credit I received when I sold that spread remains mine to keep. But as the stock rose, I started getting a little nervous, thinking, oh boy, well, hopefully that resistance level holds. And indeed it did. And the stock ended up falling back down to 153 where it is now. And that spread worked out just great.
I always knew you were Fancy Dan there, Dan, trading Ralph Lauren. Where you buy all your Bootcamp drill instructor gear at Ralph Lauren?
I sure do.
But, that's a good example. You utilize some support and resistance technical analysis to construct a methodology, a strategy behind when you'd want to implement a spread. The basic vertical, perfect example of why that's a short vertical, obviously, but the methodology holds the same way. If you're looking at being bullish a stock, you want to put on a long vertical. For the reasons we just outlined, it reduces your premium, gives you a more pure directional and Greek exposure to the position, allows you to trade a little bit more size to do the types of trades you want to do. And it's just a more risk defined, and you also have a more premium risk defined as well type of trade. So you can see exactly how much you're outlaying, how much you can lose, how much you can make. It's a very, very, very clear cut and more, I think, precise way for trading for a lot of people to come wrap their head around if they're really, really looking and fixated on and interested in risk management, which, of course, if you're listening to this show, we hope you are. And, of course, there's vertical is just one type of trade. Maybe perhaps if we dive into another example, quick rule of thumb for all of you out there who are getting into spreads for the first time. You think, how should I set up these spreads? How should I put them on? The rule of thumb you want to keep in mind when you're putting on a spread, and this applies to most spreads, it sometimes can get a little out of whack when you have a crazy multi-leg spread with ratios and things like that. But basic rule of thumb for most spreads is that these spreads make the most money. You experience the maximum profit when the underlying moves to or sits at the short strike of that spread. So when you're putting on a spread, like in this example, let's say you're looking at everyone's favorite stock, XYZ, and you want to buy along, maybe it's trading at 100, and you're thinking maybe the stock's going to rally to 105. You buy the 100-105 call spread. You're going to make the most money when that stock rallies to 105, or perhaps even a little bit beyond it. But when it's at 105, that's when you're making your maximum profit. So keep that in mind. In the short example Dan just gave us, if the stock stayed at 165 or below, he obviously kept the maximum profit from that credit that he sold as well. So in most scenarios, that's a good rule of thumb to keep in mind. As you're structuring your spreads, keep in mind that's where you want the underlying typically to be to give you the maximum bang for your buck. Underlying is not always going to play ball. It's going to vacillate around between the long strike and the short strike and do a lot of other crazy things that get into a lot more of the position management type approach to spreads. And we'll get into that on another show down the road as well, because that in many times senses you can put on the right spread. If you manage it incorrectly, then there goes most of your profits, if not all of them. So that's a good topic for another show as well. But just keep that in mind as you're starting off with spreads. That's a good way to structure them. And now, of course, the basic vertical is one example. A very popular one for a lot of stock traders as well is the collar spread. Now, what is the collar spread? This is something that traders use to protect a long underlying position. It usually involves buying a protective put, which can sometimes be expensive, so they offset some of that outlay by selling a covered call against it. Now, John, I know you over at Sogo must employ this strategy quite a bit, and also I'm sure walk a lot of your clients through this, because a lot of your clients are coming to Sogo looking to defend long stock positions. So what do you tell them when they call you up asking for information about collars?
I mean, collars are one of the great strategies, and I look at collars. Sometimes I look at them without the stock when I write about earnings in particular, because when the earnings come for these high flying stocks, sometimes the premium is so exorbitant that customers are very afraid to buy the premium. So if you buy a collar, let's say without the stock, that means you're buying a downside put, you're selling an upside call. Now you have the risk on the upside. So there is some big risk in this trade, but if you really believe in a downside move, you can decrease your debit significantly by doing this trade. I remember one example, First Solar, which is a high flying stock. Right before earnings, the Strata was trading at $4, and that was about equal to about 10.6 move in the underlying. Wow, that's a big move. So instead of buying a straddle or going out and maybe buying some puts were very expensive, we recommended, if you believed in that, to sell the weekly 40 calls and buy the weekly 33 puts. And you actually did that for net credit 11 cents. You had some risk if the First Solar went over 40, but that would have meant an 8.8% move in First Solar. So you had some upside, a buffer zone. Well, what happened? There was an earnings miss. The stock traded down to 32 on earnings day, but by expiration a few days later, it was 27.5. So the puts that you owned were now worth 550, and you actually did the whole spread for an 11 cent, a credit. Again, you had the upside risk, but sometimes when volatilities get so exorbitant, you can do collars without the stock, and you can reduce the amount of your outlay.
Collars are such an interesting and useful strategy. I think it's worth spending a couple extra minutes on them. I often jokingly refer to them as perhaps the one strategy to rule them all, because for so many traders out there, particularly the target audience for this show, the long equity trader, the collar is a uniquely situated strategy, almost uniquely perfect strategy for them. In fact, I joke about it being the one strategy to rule them all because you see a lot of people who are relatively sophisticated from a financial perspective and also from an account size, a lot of very large financial advisory firms, employing hundreds of millions, perhaps billions of dollars under management. The collar is pretty much the one strategy that they utilize when it comes to options. They pick up this strategy, they find it fits with their goals, and they utilize, and that's pretty much it. So there is significant money out there right now under management in a variety of funds and at a variety of advisory firms that they're just using collars. So if you get to know the collar fairly well and how it works, ways you could tweak it to your particular preference, like John just mentioned, a zero stock collar, aka a bearish risk reversal. There's a lot of different things you could do with this position that are interesting and I think could be compelling for a lot of equity traders looking to get into options. I think if you're interested in collars and perhaps pursuing them more, you can, of course, come to the optionsinsider.com, search for collars. We have a lot of great information and analysis on this, including some great radio shows we've done with the Options Industry Council on this very topic. They've done some very interesting studies on collars and how they perform, particularly in the Qs, but also on some other large indices. Actually, and those studies tend to disprove a lot of long-held assumptions about collars, that they underperform and do a lot of other things. They showed in a lot of their studies that not only comparing collars to owning the Qs outright or some other major indices outright, that the collars not only outperformed on a risk-adjusted basis, they blew the doors off on a risk-adjusted basis, because remember, you're adding a volatility component to your portfolio now, which is, of course, inversely correlated to the market, so it's going to give you a lot of extra bang for your buck from a risk mitigation perspective. But also, collars tended to outperform on a total return basis as well in many scenarios, and if they didn't, they were often very competitive. So the collar is a very, very good strategy for a lot of basic equity traders who are coming to options for the first time. They want to keep their long stock positions, but they also perhaps want to use options to defend their position and keep some of those gains. I just personally myself, the other day, entered into a collar on a forward position that I had. Ford was trading about 11.20. I didn't have the time to manage. I didn't want to sell out that position either. So I liked it in the 11 to 12 range. I put on I think it was February. We're trading right now in December, so a few months out. February 11-12 collar. I put it on for essentially no net outlay. So I allowed myself to lock in my gains at the 11 price level. If it goes above 12 by February, my stock is called away, and that's a perfect scenario for me. I'm fine with that. So that's a great way. That's a perfect example for you listeners. If you have a stock you like, you have a little bit of bullish outlay, you don't want to get rid of it yet. Maybe you have a stock you can't sell for a variety of legal prohibitions you may have on it. That stock collar is an excellent type of trade for you to employ in those scenarios. So there we go. Two very basic spread examples: the typical vertical call spread, or in Dan's case, the short vertical call spread, as well as the collar. Again, keep in mind that rule of thumb underlying at the short strike typically means is typically the preferable scenario for most of the spreads that you're going to employ, particularly the ones we're talking about here, the very basic, two-legged types of spreads. All right, and that's going to do it for the option drill segment right now. And now we're going to move on to the part of the show where you, the listener, gets your chance to chime in. This is, of course, the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right. This is, of course, the mail call segment where you, the listener, get your chance to sound off. And we have a couple of interesting questions coming up here. The first one's actually probably going to be a relatively involved one, so we'll perhaps get to this one first. This is the tweet from Phil S. He writes, "What's the deal with option spreads? Why can't my orders get filled? How do we fix this problem?" And this is a very, very frequent complaint we hear at Insider. I'm sure you guys, Dan and John, hear this all the time from your clients as well. And it hits on a fundamental problem with spreads. A lot of people like you, listener, come to options from stocks. And you learn to start buying simple options trades like buying a call, buying a put. And you learn to execute on what's called the NBBO, the National Best Bid and Offer. So if you lift the offer on the NBBO, you hit the bid. In this environment, in most products in the options market today, you're going to be instantly filled. So you've learned to expect that level of execution from options. And then you start graduating to simple spreads, simple verticals, simple collars, things like that. And all of a sudden, you start finding yourself in this strange no man's land where you see an NBBO on a spread. It might be bid 135, offered at $1.40. You try to pay $1.40 for that spread, and you're not filled. And you're sitting there, and you're waiting, and you're waiting, and you're waiting. The spread moves away from you. The stock moves away from you. You're still not filled. It moves your way. You're still not filled. And it's a very frustrating thing for a lot of newcomers who come to options because like you said, they've been trained to expect a certain level of execution. And now they get to the spread side, and all of a sudden, all bets are off. And why is that? Well, there's a couple of reasons, but the primary reason is that the options market, unfortunately, is a very fragmented place. We just launched a new exchange, the Miami Options Exchange, just came into the fray. So there are now 11 options exchanges competing for your business, competing for your execution on these various trades. And while that offers some benefits in terms of competition and things like that, it also offers a significant drawback, and that is that indeed that fragmentation. All of these individual exchanges have individual spread books. And so they may have that particular spread offered at different prices or bid at different prices. And what you may be seeing from your particular broker is combining the different spread books to create that national best bidder offer. The problem is these spread books tend not to talk to each other too much. So you may have a spread that, due to the NBBO, because they're calculating different things on different exchanges, may be offered at 140, but in reality, your spread is routed to one exchange, let's say the CBOE, and they could actually be at 145 on their exchange, given the prices on theirs. And the actual offer that makes a spread at 140 could be on another exchange, let's say a competing exchange like the ISE, and those two exchanges do not talk to each other. So sometimes, and it usually it falls upon third parties to make this happen, they can execute this on your behalf, but it's a very difficult and laborious process. And so sometimes it's not done rapidly, sometimes it's not done at all. And so you, the listener, could be left hanging. And then it really takes a level of sophistication to look at the spread book on a particular exchange, see where your order is resting, which spread book it's on, then see what the actual offer is on that particular spread book and perhaps adjust it accordingly to be executed. It's a difficult process. A lot of newcomers to options certainly have some problems when navigating this for the first time. Dan, what do you typically tell your clients over there when they come to you with this problem? As I'm sure they have many times. Obviously, there aren't really any solutions. Maybe we can pontificate on some potential solutions down the road. But what do you say when people come to you with this problem over at Market Taker Mentoring?
Well, most of it is just kind of the education like you just provided, Mark. It's just a lot of people come and they say, what the heck's going on? Those market makers are ripping me off. They won't even fill me, and they just don't understand how it all works. So the education is half the battle. But then, of course, it can be overcome somewhat, I think, if you look at market depth, you look where the bids and the offers are. I mean, if there's a 30-cent bid out there, well, there's a real person somewhere in the world bidding 30 cents. Where are they? Are they on the SIBO? Are they on the ISE? Are they on the Amex? Are they on all three? Go and look at that exchange breakdown of the bids and offers, and then you can leg the spread yourself if you want. If the SIBO's bid 30 cents and you're trying to sell at 30 cents, but there's a different exchange on the offer, then send one order to the SIBO, one order to the other exchange. It takes a little bit more labor, but hey, man, if trading was easy, everybody do it.
Yeah, it takes some labor, and certainly in that case, some delta risk as well, because you could be left hanging on one leg or the other. Some execution risk, which some people are afraid to do. But that's unfortunately the scenario we find ourselves in right now, where that still is, in many cases, what you need to do if you want to have maximum quality spread execution. Now, John, I'm sure you encounter this as well with a lot of your clients. What do you do when they call up with their questions on this subject?
Well, Dan kind of stole my thunder on this one, and I was going to say,
sorry.
Well, I guess great minds, think alike. But again, it was really we advise exactly what Dan said to leg into the spread. If you're saying, why am I getting filled? There is some risk by legging in. If you do one side and then you try to do the other side, you can miss it. But the one thing I wanted to mention about spreads, and this is a little off topic, but I did want to bring it up. We've talked about in the past the use of market orders and versus limit orders. And we advise our clients to not use market orders and spreads. Now remember, when you're just doing a single leg and you have the market, let's say one bid out 120, and you want to buy the option, fair value is theoretically 110. If you pay 120, you're really giving up about 10%. Now, if you bid 110, you may get filled. If you bid the 112, you may get filled. So the use of market orders in straight limit orders is not advisable unless you really need to get into something. With spreads is even more so. I mean, I have one of my favorite trades is a butterfly. And with a butterfly, sometimes if I just went down market, it may cost me $1 to do the butterfly. But if I go mid-market, it could be 30, 40 cents, and I'll get filled maybe 35 cents. So, I tell the customers, be careful using market orders for spreads. If you go mid-market a little bit above, and you're patient, and you're in a liquid option, you may get filled.
Getting back to Phil's here, the last part of his question, how do we fix this problem? That's a lot of great minds are working on that problem right now, Phil, and a lot of top men, as they like to say, are working on this issue. We've seen a number of third-party solutions come out and attempt to address this. Also some internal solutions. We've seen at the ISE, for example, they have some implied order functionality where they can attempt to, at the very least, help execute some of these spreads that are bid on their order book and orders they have resting there. But that's limited to one exchange. I think at the end of the day, the real solution to this is going to be with some of these third-party exchanges that have access to a lot of the order flow, perhaps are aggregating a lot of the order flow through their smart routers, and can facilitate some of this activity themselves. There seems to really need to be a third-party solution that comes from one of these firms that can work with all of the exchanges as opposed to one exchange trying to implement one thing, one exchange trying to implement something else. That gets into that fragmentation issue again. If there are a couple players out there who have access to enough order flow to be able to facilitate this on behalf of some of their clients. So I think that we'll have to wait a little while, unfortunately, Phil, to get the true ultimate solution to this problem. In the meantime, unfortunately, dear listener, if you're trying to do anything, and I don't mean to overplay this. It's not like spreads are impossible to trade if you're doing a lot of very basic spreads near the at-the-money strikes, near the front month in popular names like Amazon or Google or Apple, something like that, Ford, for example, you can usually leg in pretty easily and get filled pretty easily. And if you're willing to be a little flexible with your trading prices, you can certainly get them done. But in some of the more, let's say, farther off months or some of the less liquid names, then it becomes a bit of an issue, and you really have to do a little bit of legwork yourself to literally leg the spread yourself, which is execute each of the individual parts separately, and then, of course, entails some risk and some labor on your part. But if you're willing to do that, that's also a solution you have. So in the near term, unfortunately, Phil, no ideal scenario, but I think people are working on it. I hope in the next couple of years we see something that can facilitate this type of functionality. So the NBBO for spreads can truly be an NBBO, and that if you're a customer looking to hit bids or lift offers, you can reasonably expect the same level of execution that you get when trading single leg option spreads. And next up, we have a question from one of John's clients over there at Sogoland, and he writes, how do I know if a spread is worth doing or has some trade value? Now, John, I know this is a frequent one you receive, which is why you forwarded it over to me. What do you tell those clients who call up asking this very insightful question?
I mean, the main answer that I give is, pick a strategy. And again, don't use one strategy, but if you have a sweet spot, pick a strategy and kind of stick to the rules. I mean, the perfect example I always give is that one of my favorite trades of all time is when it occurs what they call reverse skew. And skew is an issue that we haven't really gotten into in the past, but basically the out of the money calls it's almost nearly universal, are always going to be cheaper than the at the money calls. When you see an opportunity where that reverses and the out of the money calls become more expensive in volatility terms than the in the money calls, a green light goes off in my head and says, whoa, something may be up. Are there takeover rumors? Is there a new product coming out? Is biotech, new drug coming out? So I love putting on vertical spreads. If I can buy the at-the-money call for a volatility that is similar or less than the out-of-the-money call. So that's for me, that's a value trade. So I have a determination in my head what a value trade is, and I stick to it. And we have gone over in the past, and I won't spend too much time on this, but there's a reason why the out-of-the-money calls are almost always cheaper than the at-the-money calls. And there's also a reason why the out-of-the-money puts are always higher or almost always higher than the at-the-money puts. We won't go into that now, but again, stick to a trade strategy or trade what you consider value, and in the long term, that will serve you well.
Now, Dan, this is in many ways the million-dollar question. How do you identify a valuable spread that is worth doing? I'm sure you receive some iteration on this question on a regular basis over there at Market Taker Mentoring. So what do you say to those clients who come to you with this, looking for the answer, if you will?
Edge, baby, edge. And as far as edge goes, there's kind of two types of edge. There's market maker edge, like we used to do down on the
a little slip of the tongue there, sir, getting the plug in.
Exactly. And, the way market makers evaluate edge is just simply buying below theoretical value, selling above theoretical value, try to make a couple theoretical cents. But market takers, and now I will shamelessly plug market taker, they get edge a little bit differently. They look for statistical advantage, which is what market makers really don't do. What they do is, if it's an option selling strategy like a credit spread, they'll make sure that there is some pretty solid support and resistance lines to give them somewhat of a technical advantage. And they'll also look at volatility and make sure that implied volatility is somewhat elevated so that they can get a volatility advantage to their trades. And of course, if they're doing a debit spread in option buying strategy, they'd probably still be looking for that support and resistance technical advantage, but they'd also look for inexpensive volatility. They'd be looking for cheap volatility to buy.
All right, there you go, listeners. The answer to the million-dollar question. It's what we were all taught to look for on the trading floor. That is indeed edge. If you can find some edge, then you will be a profitable trader in the long term, and usually the best way to find edge is to utilize spreads. This is why we spent so much time on it today, and we'll spend even more time on it in the upcoming episode, because spreads are where the rubber meets the road in the options world. But unfortunately, that's all the time we have for this episode of Options Bootcamp. Before we go, I like to check in with my fellow drill instructors to see what they have going on that may interest you, the listener. Starting off with you, John, the Major Domo over there in Options Land at Sogo. What is coming up in the land of Sogo that may interest our listening audience?
We have a new Power Options coming out. We're hopeful, the first month of the year. It's actually ready, been through the beta testing. We're just waiting for, product launch. We are working on enhancing our multi-leg spread capability. And I've been working on that real hard to get that done by the end of the year, but there's been a slight delay there. But we'll have that early in the year, and we're going to continue to write and do some webinars and maybe some in-house seminars. So we're very much looking forward to 2013. Should be great.
Yeah, a lot of interesting stuff coming down the pike from Sogo, especially that multi-leg functionality. That's where a lot of our listeners are headed, John. So it's good to have that functionality in place for them. After they listen to this show, they get up to speed on all these various concepts, and they can come over to Sogo, and they can start executing these multi-leg trades. So there you go, getting the groundwork laid for them ahead of time. And last but certainly not least, Mr. Dan, what is coming up in the land of market taker mentoring?
Oh, boy, you know what? I have been planning 2013, and we've got a very, very, very exciting year. I know I mentioned our group coaching the last couple of times, but we're beefing up our online education classes. We're going to probably in February be accepting applications for one-on-one coaching again, which we do just about 3 times a year maybe. So we're really excited about that, to get some fresh blood in the door as students.
There you go, listeners. You can get some quality one-on-one time with Mr. Dan over there at Market Taker Mentoring. I know I love all the one-on-one time I can get with Dan. So now you too, the listeners, can benefit from that experience. Surf on over to markettaker.com and see for yourself what they have to offer over there. And before we go, of course, if you'd like to learn more about any of the topics we discussed on this program today, or listen to any of our archived episodes of Options Bootcamp, then by all means surf on over to theoptionsinsider.com. We have a wealth of educational information ready for you at your fingertips. You can find anything you're looking for just by typing it into our search bar: covered calls, protective puts, collars, that sort of thing. We also have a wealth of radio programs, not just the archive episodes of Options Bootcamp, but all of our other popular options programs on our network. Of course, you can find those in iTunes and Stitcher, as well as other leading online audio outlets. So there's a lot of great content waiting for you over there at theoptionsinsider.com. Head on over there, check it out, and see for yourself. And of course, all of us here on the old Options Bootcamp Drill Instructor Squad want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.